Microsoft and Meta just spent more than $70 billion on capital investment in a single quarter. In early after-hours trading, Microsoft initially rose while Meta fell. So no, Wall Street isn't simply punishing AI spending. It's asking a different question. Can you draw a visible bridge from the data center to the cash register? If you own a large cap tech fund, that question is already inside your portfolio. Nearly every major platform is asking investors to fund the AI build-out before the final returns are fully visible. The winners won't necessarily be the companies that spend less. They'll be the companies that make the bridge easier to see. And right now, Microsoft's bridge looks shorter. Microsoft spent about $41 billion in the quarter, including finance leases. It still generated $55.4 billion in operating cash flow and about $19.6 billion in company-reported free cash flow. Meta spent about $31.1 billion. It generated nearly $31.9 billion in operating cash flow. But after property, equipment, and finance lease payments, free cash flow was just $784 million. One company spent more and still had almost $20 billion left by its reported measure. The other spent less and had less than $1 billion left. That's the contradiction. If you're comparing these companies, don't start with what went out. Start with what came back. But cash flow is only the last plank on the bridge. To understand why investors could see Microsoft's return more clearly, we have to start at the other end, with the physical build-out. Microsoft added 31 data centers and 1 gigawatt of capacity during the quarter. That's a huge amount of infrastructure. It's also not a return. A server rack doesn't become valuable because it lights up. It becomes valuable when customers use the capacity, pay for products built on it, sign contracts, and eventually produce cash. So what came across Microsoft's bridge? First, cloud growth. Azure and other cloud services grew 43%, and annual Azure revenue moved above $100 billion. Put simply, Microsoft isn't building into an empty room. Its largest cloud business is still accelerating at enormous scale. But Azure isn't a pure AI segment. It includes plenty of traditional cloud work, so we can't call all 43% AI revenue. That takes us to the next plank, paid adoption. Microsoft 365 Copilot passed 30 million paid seats, and net paid seat additions doubled from the previous quarter. GitHub Copilot reached 50 million users. Those numbers still don't tell us exactly how much revenue each product produced. Paid seats can include enterprise bundles and discounts, but they're more useful than a download count. People aren't only trying the product, companies are paying to put it inside their workflow. You can see why that matters. Then comes contracted demand. Microsoft's commercial remaining performance obligations reached $678 billion, up 84%. That sounds like $678 billion of revenue waiting right outside the door. It isn't. If you stop at the headline, you'll mistake long-dated commitments for next year's sales. The figure includes a large OpenAI component. Excluding OpenAI, commercial RPO grew 25%, and Microsoft expects only about 30% of the total to be recognized over the next 12 months. So the backlog is real. The headline is simply much longer dated than it first appears. And this is where Microsoft's case gets stronger. Even after stripping away some of the excitement, you can still see multiple independent planks. Capacity, Azure growth, paid Copilot adoption, contracted demand, operating profit growth, and positive free cash flow, not one perfect number. A chain of evidence. Now we need to make an important correction. Microsoft's quarter wasn't clean. Investment accounting affected the comparison, including an Anthropic gain and the impact of its OpenAI investment. GAAP net income grew 31%, but Microsoft's adjusted figure grew 22%. That's why the cleaner operating number matters more. Operating income still grew 18%. The investment marks made the headline prettier. They didn't create the entire operating story. So if Microsoft built the more visible bridge, does that mean Meta's AI strategy failed? No, that would be the lazy conclusion. Meta's core business is exceptionally strong. Revenue grew 28% to $60.8 billion. Ad impressions rose 14%, while the average price per ad increased 12%. More ads, higher prices. At the same time, Meta also gave investors real evidence that AI is improving its advertising machine. One system increased Facebook ad clicks by 8.3% and conversions by 15.7%. Advantage Plus moved above a $75 billion annual revenue run rate, and more than 9 million small businesses were using Meta's generative AI creative tools. Those aren't imaginary benefits. They're why you shouldn't describe Meta as a company pouring money into AI with nothing to show for it. But here's where the bridge becomes harder to follow. Those product improvements don't yet provide a clean revenue trail for the entire frontier model and infrastructure build-out. Meta can show that AI improves recommendations, engagement, and advertising. It can't yet assign a definitive timeline to the broader return from all the models, agents, chips, networks, and data centers. It's funding. Management itself said it didn't have a more definitive timeline to share. And while that timeline stays open, the current bill is getting larger. Meta's total costs rose 55%, more than twice its revenue growth rate. Its GAAP operating margin fell from 43% to roughly 31%. For every $100 of revenue, Meta spent about $51 on capital investment and retained only around $1.30 of free cash flow by its reported definition. Strong product, weak quarterly cash conversion. Now, another correction matters. Meta recorded $2.4 billion of legal charges and $1.18 billion of severance. Excluding those items, management says operating income would have grown 9%. So AI spending didn't cause every dollar of the reported profit decline. If someone tells you it did, they're skipping $3.58 billion of inconvenient detail. But the correction doesn't erase the cash flow question. Free cash flow fell from $8.55 billion a year earlier to less than $800 million, and Meta raised the lower end of its 2026 capex guidance again to a range of $130 to $145 billion. One quarter doesn't tell you the lifetime return on a data center. Meta also held more than $90 billion in cash and marketable securities. It can afford to keep building. The question is how long investors will fund the missing section of the bridge before demanding a clearer view of the other side. And if you're judging the next quarter, don't stop at today's income statement. And that's where the accounting clock starts ticking. Capital expenditure reduces cash now. The income statement cost arrives later through depreciation. Microsoft said roughly 2/3 of its quarterly capex was short-lived CPUs and GPUs. Meta's server and network depreciation rose from $7.3 billion in 2023 to $13.4 billion in 2025. Cash now cost later. And unlike a concrete building, a cutting-edge AI chip can become economically old long before the walls around it do. That doesn't prove the spending will fail. It means the bridge needs traffic before the maintenance bill catches up. We've already seen how quickly the market can change its mind. In January 2026, the initial reaction was almost the mirror image of July. Microsoft fell roughly 10% after investors focused on spending, capacity constraints, and the time needed for growth to catch up. Meta rose roughly 10% because its advertising outlook made the investment look easier to finance. 6 months later, the early verdict reversed. Same companies, same AI race, different evidence. This isn't a repeat of the dot-com bubble, and it doesn't prove either stock will move in a particular direction next quarter. It's a credibility cycle. Spend first, show the return, earn permission to spend again. So why did investors initially reward Microsoft and punish Meta? Not because Microsoft spent less. It didn't. And not because Meta's AI products aren't working. Some of them clearly are. Microsoft currently has a shorter visible bridge from infrastructure to cloud growth, paid adoption, contracts, operating profit, and cash. Meta has several strong planks, especially advertising performance, but the connection from its broader frontier model spending to material new revenue is still harder to see while free cash flow is under pressure. That verdict is conditional. So what should you watch now for Microsoft? Watch whether new capacity keeps producing Azure growth, paid Copilot adoption, and free cash flow after the investment accounting noise fades. For Meta, watch whether free cash flow recovers and whether management begins reporting a clearer revenue or return timeline for the next generation of AI products. Wall Street isn't asking big tech to stop building. It's asking where the bridge leads and whether the cash arrives before the rebuilding starts. AI spending isn't the verdict. The bridge is. This isn't individualized investment advice. It's a framework for judging whether extraordinary spending is becoming an extraordinary business.